The 5 best credit cards by category. An institutional capital optimization framework. A quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. If you're managing significant capital flows and wondering which credit instruments actually enhance your financial architecture versus simply deferring payment obligations, this analysis deconstructs the 5 category-leading cards through the frameworks that wealth advisors charge $5,000 to explain. You will understand the tax timing mechanisms behind strategic credit deployment, the liability structuring implications for business owners, how to calculate true cost of capital when annual fees approach $1,000, the precise utilization ratio management required to preserve future borrowing capacity, and why category bonus structures either amplify or undermine your overall capital efficiency. This represents institutional analysis typically reserved for 7-figure portfolios. Most people approach credit cards as rewards programs. You're about to understand them as liquidity architecture. You'll want to take notes because these mechanisms separate those who pay for convenience from those who engineer measurable financial advantage. When institutional investors evaluate credit instruments, they're asking how this tool modifies capital structure, tax position, and access to future credit. Credit as liquidity architecture means understanding that every card in your wallet represents a contingent liability affecting your debt-to-income calculations for mortgage underwriting, your business credit profile for SBA financing, and your tax treatment depending on whether you operate as sole proprietor, S corporation, or C corporation. The cards we examine today are category leaders because they solve specific institutional problems through measurable optimization within defined financial frameworks. The Business Platinum card from American Express carries an $895 annual fee and earns 5 points per dollar on flights and prepaid hotels booked through Amex Travel, plus 2 points on purchases at construction material suppliers, electronics retailers, software providers, and shipping, as well as on each purchase of $5,000 or more. But institutional analysis focuses on entity structuring and tax optimization, not point accumulation. For S corporation owners operating under IRS Code Section 1363, every business expense dollar reduces taxable income at your marginal rate approaching 37% federal plus state obligations. The Amex Business Platinum provides up to $600 annually in hotel credits through Fine Hotels and Resorts or the Hotel Collection, $200 airline fee credit, $200 at Hilton Properties, $150 Dell credit plus $1,000 Dell bonus credit if you spend $5,000 or more annually, and $250 Adobe credit. Aggregate these statement credits, approximately $2,000 annually, against the $895 fee, and you're operating with an effective net benefit of $1,105 if fully utilized, representing a 123% return. Here's where sophisticated operators separate from casual users with the Amex Business Platinum. These credits reset on calendar year cycles, not membership year cycles. Open this card in November, access Dell, Adobe, and airline credits before December 31st, then receive fresh allocations January 1st, effectively doubling first-year value extraction to approximately $3,100 in credits against a single $895 fee. That's a 346% first-year return, exceeding typical investment-grade corporate bond returns by approximately 20 times. Modern corporate cards now underwrite based on cash flow rather than requiring personal guarantees, protecting founders' personal credit scores. This represents a fundamental shift in how credit instruments interact with your balance sheet. Traditional business cards requiring personal guarantees meant card issuers could pursue personal assets, home equity, brokerage accounts, retirement funds, if business defaulted. This created undisclosed contingent liability discovered during mortgage underwriting or institutional capital raises. No personal guarantee business cards preserve your personal debt-to-income ratio for residential real estate acquisition, protect personal assets from business creditor claims, and establish genuine entity separation, which the IRS requires to maintain limited liability protections for S corporations and LLCs. Institutional advisors recommend clients with businesses under separate tax IDs prioritize corporate cards with no personal guarantee over consumer cards reporting to personal bureaus, even when consumer card rewards appear superficially more attractive. The Chase Sapphire Reserve carries a $795 annual fee, positioning it as the highest fee publicly available personal card. The Chase Sapphire Reserve earns 8 points per dollar on Chase travel purchases, 4 points on flights and hotels booked directly, 3 points on dining in drugstores worldwide, and 1 point on all other purchases. Point accumulation without redemption strategy represents latent value, not realized value. The framework involves transfer partner liquidity. Chase Ultimate Rewards points transfer one-to-one to Hyatt, United, and Southwest. Transfer to Hyatt and redeem for Category 8 properties during peak seasons, extracting valuations approaching 2 cents per point or higher through points boost with select airlines and hotels. Compare to baseline 1 cent per point for cash back, and you're achieving a 100% value premium. The difference between extracting $1,500 versus $3,000 from 150,000 points. The Chase Sapphire Reserve provides $300 annual travel credit applying automatically to ride-hailing, cruise lines, Airbnb, and subway fares, plus up to $500 credit annually for 2-night stays booked through Chase Travel at the Edit Collection properties. These statement credits represent non-taxable cost basis reductions. For 2 employees traveling personally, this equals approximately $1,000 pre-tax income at 30% effective rate. For business owners deducting travel, the credit reduces deductible expenses, trading tax deduction for cash refund, generally favorable since cash value exceeds tax benefit. Additionally, Chase Sapphire Reserve cardholders receive up to $300 annually in dining credits at Sapphire Reserve exclusive tables restaurants and up to $300 annually for StubHub and Viagogo purchases. Aggregate the $300 travel, $500 edit, $300 dining, and $300 StubHub credits. $1,400 against $795 fee, yielding net benefit of $605 if fully utilized, representing 176% return. Straightforward cashback cards focus institutional analysis on cost of capital and timing rather than reward maximization. The Citi Double Cash Card's flat rate 2% cashback structure, 1% when you purchase, 1% when you pay, creates predictable cost basis reduction valuable for thin margin businesses or high bracket individuals seeking simple, transparent value. The framework involves time value of money through credit float periods. Purchase on February 1st with payment due March 5th deploys the bank's capital 33 days interest-free. Operating a business with 8% weighted average cost of capital, That 33-day float on $10,000 monthly spending represents approximately $73 avoided financing cost annually. Add $200 annual cash back on that flow, and all-in benefit is $273 annually per $10,000 monthly, a 2.73% effective return before tax treatment. The Inc. Business Cash Credit Card earns 5% cash back on the first $25,000 spent in combined purchases at office supply stores and on internet, cable and phone services each account anniversary year, plus 2% on the first $25,000 at gas stations and restaurants. 5% versus 2% represents 150% premium superficially. But sophisticated capital allocators understand opportunity cost and behavioral economics with cards like the Inc. Business Cash. Category bonus cards create expense matching friction and cognitive overhead. Expense matching friction requires actively directing specific categories to specific cards. Manual tracking or automated systems many small businesses lack. Accidentally running office supplies through your 2% card instead of the Inc. Business Cash's 5% card creates negative 3% value leakage. Cognitive overhead from institutional behavioral finance research costs approximately 2 to 3% of annual spending for time-constrained high-net-worth individuals. Business owners generating $500 per hour, spending 10 hours annually managing category optimization for the Inc. Business Cash incurs a $5,000 opportunity cost. Unless category optimization generates more than $5,000 incremental rewards versus flat rate structure, you're destroying value while appearing to create it. Credit utilization ratio. Total outstanding balances divided by total available credit represents approximately 30% of FICO score calculation. When exceeding 30%, you experience score degradation affecting access to low-interest financing for mortgages, auto loans, and business credit lines. Carrying $5,000 across $20,000 limits operates at 25% utilization, acceptable. Close one card with a $10,000 limit avoiding annual fee, and new utilization becomes 50%, reducing FICO score 30 to 50 points. That score reduction might increase mortgage interest rate 25 basis points on a $500,000 30-year loan, costing approximately $22,000 additional interest over loan life. You saved a $95 annual fee and incurred a $22,000 financing cost increase, a 23,100% negative return. No annual fee cashback cards serve as credit profile infrastructure, not primary spending instruments. Cards like Chase Freedom Unlimited or Chase Freedom Flex provide 1.5 to 5% cash back with zero ongoing cost. Institutional value isn't reward maximization, it's cost-free credit line expansion. Opening a Chase Freedom Unlimited or Freedom Flex with $15,000 limit and leaving it active with one small purchase every 6 months adds $15,000 to total available credit with zero carrying cost. With $30,000 in other lines, you've increased total credit from $30,000 to $45,000, 50% expansion. Typical $6,000 balances for cash flow management drop utilization from 20% to 13.3%, preserving FICO in excellent range, ensuring most favorable rates when pursuing high-value financing. For business owners operating as S corporations, every business expense charged to business credit cards must meet IRS substantiation requirements under Code Section 274, documenting business purpose, amount, date, and relationship to operations. Business cards like the Amex Business Platinum and Inc. Business Cash provide integrated expense management, automatic categorization, receipt matching, employee spending controls, reduce tax compliance burden, and minimize audit risk. Unified platforms matching receipts to transactions instantly eliminate end-of-month reconciliation through streamlined approaches. When accounting firms charge $150 per hour for bookkeeping and automated expense matching saves 10 hours annually, you've generated $1,500 value before considering rewards. Sophisticated institutional approach involves constructing card portfolio optimization across multiple objectives simultaneously. For business owners with personal and business expenses, optimal structure typically involves one premium business travel card like the Amex Business Platinum for flights, hotels, and large purchases maximizing bonus categories. One flat-rate business cashback card like the Inc. Business Cash for everyday expenses where category management creates friction. One premium personal travel card like the Chase Sapphire reserve accessing lounge networks and travel credits. And 1 to 2 no annual fee cards like Chase Freedom Unlimited held purely for utilization ratio management and backup payment methods. This portfolio approach maximizes category bonuses where you naturally spend while defaulting to simple flat-rate cards for miscellaneous expenses, maintains optimal utilization ratios across the entire credit profile, and accesses highest value premium benefits without paying redundant annual fees for overlapping perks. Institutional benchmark. Total annual fees across all cards should generate at least 3 times their cost in measurable value. Through statement credits you'd pay anyway, rewards redeemed at premium valuations, or operational efficiencies reducing professional services costs. Single largest risk factor destroying premium card value with the Amex Business Platinum and Chase Sapphire Reserve. Statement credit forfeiture. Credits reset on different schedules. Biannual credits resetting differently than annual credits, and anniversary-based credits on yet another schedule, making it easy to leave hundreds of dollars unused. Miss one credit cycle, you've permanently lost that benefit for that period. Institutional risk management requires systematic processes. Calendar alerts 60 days before each credit period expires, pre-planning qualifying purchases, ensuring you'll use credits even if organic spending doesn't align, and understanding specific terms for each credit to avoid disqualification. Paying an $800 annual fee while extracting only $400 value. 50% utilization makes premium cards economically inferior to no annual fee alternatives. When applying for mortgages, lenders calculate debt-to-income ratio dividing total monthly debt obligations by gross monthly income. Credit card minimum payments count as debt obligations, even paying balance in full monthly. With 3 cards totaling $50,000 credit limit, mortgage underwriters assume minimum payment 1 to 2% of total available credit, $500 to $1,000 monthly. For business owners, understanding tax treatment separates the Citi Double Cash from travel cards like the Chase Sapphire Reserve and Amex Business Platinum. Cashback rewards are generally treated as purchase price reductions rather than income, meaning they're not taxable, but they do reduce your deductible expense. If you purchase $1,000 office supplies and receive $20 cash back, your tax-deductible expense is $980, not $1,000. At a 37% marginal federal rate, you're trading $7.40 in lost tax deductions for $20 cash, net $12.60 benefit, representing 1.26% true value after tax effects. For the Amex Business Platinum and Inc. Business Cash held under S Corporation structure, absolute separation is critical. Under S Corporation tax treatment, the business doesn't pay federal income tax. Instead, profits and losses flow through to your personal return via Schedule K. 1. When you use business credit cards for any personal expenses, even inadvertently, you've created a constructive distribution that's taxable as income to you personally and potentially triggers payroll tax obligations. This is why institutional S corporation tax planning requires absolute separation. Business cards for business expenses only, personal cards like the Chase Sapphire Reserve for personal expenses only, and rigorous expense categorization to ensure you can demonstrate to the IRS that you're maintaining proper entity separation. The cost of failing this test: having your S corporation reclassified as sole proprietorship, losing limited liability protections, and owing back taxes plus penalties. Before we end, let me summarize these 4 critical insights separating institutional credit optimization from consumer tactics. First, premium cards like the Amex Business Platinum at $895 and Chase Sapphire Reserve at $795 can generate 150 to 300% returns if you systematically extract full statement credit value, but only if you build processes avoiding forfeiture and understand specific redemption requirements for each credit. Second, no personal guarantee business cards like the Amex Business Platinum and Inc. Business Cash create genuine liability separation, protecting personal assets and preserving personal debt-to-income ratio for residential real estate acquisition, making them institutionally superior to consumer cards even when consumer rewards appear superficially more attractive. Third, credit utilization ratios affect 30% of FICO score calculation. Closing cards like Chase Freedom Unlimited to avoid annual fees can cost tens of thousands in higher mortgage interest rates over loan life, catastrophic value destruction, far exceeding any annual fee savings. Fourth, strategic card portfolio construction across the 5 cards we analyzed. Amex Business Platinum for business travel, Inc. Business Cash for category optimization, Chase Sapphire Reserve for personal travel, Citi Double Cash for simple cash back, and Chase Freedom Unlimited or Freedom Flex for utilization ballast, provide superior risk-adjusted returns compared to maximizing any single card. Here's the final institutional verdict. The best credit card doesn't exist absolutely, only relative to your specific financial architecture, tax entity structure, organic spending patterns, and capacity to extract value through systematic processes. For business owners with significant travel expenses and discipline to use statement credits before expiration, the Business Platinum card from American Express at $895 provides the highest absolute value if extracting a full $2,400 in annual credits. For personal travel with simpler mechanics and automatic credits, the Chase Sapphire Reserve at $795 delivers $1,400 in credits, requiring less behavioral optimization. For business owners seeking category optimization without excessive complexity, the Inc. Business Cash provides 5% returns on common business expenses. For individuals valuing simplicity and minimizing cognitive overhead, the Citi Double Cash with flat-rate 2% cashback and no annual fee provides superior risk-adjusted returns, delivering value automatically. The institutional framework always returns to first principles. Understand your true cost of capital, including opportunity costs. Structure credit relationships to enhance rather than undermine future borrowing capacity. Maintain rigorous entity separation between business and personal spending to preserve tax benefits and limited liability protections. And build systematic processes to extract full value of premium card benefits rather than paying annual fees while leaving hundreds of dollars in statement credits and used. This is how institutional capital allocators approach credit instruments, not as reward sources, but as components of comprehensive financial architecture designed to enhance after-tax, risk-adjusted returns across your entire balance sheet. Subscribe for more institutional-grade analysis, treating financial instruments as strategic tools rather than tactical rewards. Please click the thumbs up button to like if this framework changed how you evaluate credit cards. Comment with questions about your specific financial structure or requests for future content topics. I am not your financial advisor. This content is for educational purposes only. Consult with qualified tax professionals, attorneys, and financial advisors before making credit card decisions that affect your entity structure, tax position, or borrowing capacity.